The VIX closed at 1889 on June 25, 2026, up from 1863 the prior session, a move of 0.26 points. That sounds quiet, but the direction matters. Options markets spent most of this quarter pricing in a near-pristine macro environment, with the VIX compressed well below 18. Thursday's close breaks cleanly above that level. The low volatility trade that defined the spring is no longer working, and that has direct consequences for how portfolios need to be positioned. Let's ground this. The VIX, the CBOE Volatility Index, is derived from S&P 500 options prices across a range of strikes and maturities. It reflects what traders are collectively paying for protection against large moves over the next month. Below 15 is the classic complacency zone. Markets expect smooth sailing. Between 15 and 20 is elevated caution territory. Investors are paying up for hedges but haven't fully de-risked. Above 20 tends to correlate with genuine risk-off behavior, forced deleveraging, fund redemptions, cross-asset correlation spikes. At 1889, the market is not panicking, but it is no longer pricing in a world where nothing goes wrong. Three observable inputs support where the VIX is today. First, the 10-year Treasury yield sits at 4.5% as of June 23rd, per Fed, meaning the risk-free rate is high enough to punish high multiple equities the moment growth disappoints. Second, the unemployment rate printed at 4.3% in April, above the Fed's longer-run estimate, leaving the central bank's reaction function genuinely ambiguous. Traders cannot confidently price the Fed's next move, and that uncertainty feeds directly into options premiums. Third, earnings season introduces company-level event risk across the S&P 500. When multiple large-cap names are in their reporting windows simultaneously, individual stock implied volatility spikes pull the index-level VIX higher, even without a market-wide catalyst. The first-order equity effect is sector rotation. Growth-oriented names, particularly in technology and consumer discretionary, face the most multiple compression when the VIX rises above 18 and the 10-year yield holds at 4.5%. Higher discount rates make distant cash flows less valuable, and that math is unforgiving for high multiple tech names. The Nasdaq-100 ETF, QQQ, is the most direct expression of this pressure. On the other side, defensive rotation is underway. Utilities via XLU, consumer staples via XLP, and healthcare via XLV historically absorb inflows when the VIX moves through 18. A balanced stock-bond portfolio also gets a second look here. At 4.5%, Treasuries function as a genuine hedge again rather than a drag. The macro backdrop gives context to why volatility has room to stay elevated. The Consumer Price Index stood at 332.4 in April 2026, the latest Fed print, still reflecting above-trend inflation relative to pre-2020 norms. The Fed funds rate, last printed at 3.64%, shows the central bank has cut from its 2023 peak, but hasn't moved aggressively. With unemployment holding at 4.3% and inflation embedded in the index, the Fed is data-dependent in both directions, which is another way of saying markets cannot anchor on a clear policy path. That ambiguity keeps implied volatility structurally bid. For investors watching volatility instruments directly, the VIX move from 18.63 to 1889 plays out first in the front end of the futures curve. Short-dated products like VXX, the iPath Series B S&P 500 VIX short-term futures ETN, and leveraged exposure through ProShares UVXY track near-term VIX futures, not the spot index. The distinction matters. The curve structure determines roll costs and the viability of short vol strategies. As the spot VIX approaches 20, the risk of near-term futures pricing above longer-dated ones increases, and that is the condition under which short volatility strategies begin facing sustained margin pressure. Two key levels define the next chapter. Above 20, systematic volatility targeting funds, risk parity portfolios, and trend-following strategies are forced to mechanically reduce equity exposure. That is the level where a gradual repricing stops being a reallocation story and becomes a forced selling story. Below 17, the compression trade returns, put premiums deflate, and the spring positioning reasserts itself. At 1889, the VIX sits exactly at the inflection point, close enough to both extremes that neither bulls nor bears have conviction on direction. Any Fed communication, labor market data, or significant earnings miss can resolve it quickly. Track the level, not the sentiment.